Welcome back to Deep Macro Lens. Are you sure your retirement dream isn't a disguised trap? In today's volatile economy, many people are preparing the wrong way for old age, and they don't even know it. Is your retirement plan silently being destroyed by fatal mistakes? I'm Ryan Oliver, and I've spent over 2 decades dissecting the secrets of global markets and economies. In this podcast, we'll confront the challenges lurking in your financial future. And most importantly, I'll equip you with sharp defensive strategies, not just to protect, but to thrive in your retirement years. We've all been taught about traditional retirement models: Social Security, company plans, individual accounts. These foundations, built in a different world, are showing fatal limitations in today's macroeconomic landscape. First, inflation, the silent thief of retirement savings. Do you think $1 million today will be enough for you in 10 years? Think again. The average annual CPI inflation rate in the US has been 2.9% over the past decade, from 2015 to May 2025. While it has cooled from its peak of 9.1% in June 2022, this average inflation rate is still higher than the Federal Reserve's 2% target. What does this mean for your retirement money? Simply put, with a 2.9% annual inflation rate, the purchasing power of $1 million you accumulate today will be equivalent to only about $745,000 after 10 years. That's $255,000 evaporated, not stolen, simply because you forgot to factor inflation into your plan. Second, rising longevity and mounting healthcare costs. Living longer, costing more. Medical advancements are helping us live longer, which is wonderful. Average life expectancy in the US now exceeds 78.4 years, according to the latest 2023 data. This means you'll live longer and need more money for more retirement years. Crucially, healthcare costs are skyrocketing, far outstripping general inflation. A 65-year-old couple in the US may need over $300,000 after taxes just for healthcare expenses throughout their retirement. This figure does not include daily living expenses. If you don't plan carefully, healthcare costs alone can deplete your retirement fund, turning your dream of comfort into a burden. Third, public debt risk and currency debasement from current policies. A double-edged sword. This is a macroeconomic monster often overlooked, but profoundly impacting your retirement wealth. The U.S. national debt has already exceeded $36.2 trillion as of May 2025, and the debt-to-GDP ratio stands at around 108%. This massive debt becomes even more alarming when we look at recent fiscal policies. For instance, President Trump's recent One Big Beautiful Bill Act is being pushed forward, designed to permanently extend tax cuts and add spending, while also proposing nearly $700 billion in cuts to crucial healthcare programs like Medicaid. Independent analysts estimate the total national debt is projected to surge to $52.1 trillion, equivalent to 118% of GDP by 2035. This colossal debt, fueled by such policies, can lead to two dangerous scenarios directly eroding your retirement wealth. Higher inflation. When the government borrows or prints more money to finance massive deficits, it increases the money supply, driving up prices and eroding the dollar's purchasing power. Currency debasement. Huge national debt can reduce investor confidence in the dollar, leading to the currency losing value against other global currencies. This particularly affects retirees planning to spend abroad or buy imported goods. Fourth, lack of investment diversification or excessive caution. Putting all your eggs in one basket. Many people either hold too much cash, which inflation erodes daily, or invest solely in one asset class, too risky when markets fluctuate. Failing to diversify or adjust investment strategies according to different macroeconomic phases is a major mistake, leaving your assets vulnerable to market shocks. Fifth, overlooking the importance of early and consistent contributions. Lost power. The magic of compounding works most powerfully with time. This is a fundamental principle often ignored. If you start investing at age 20 with $5,000 annually, you'll accumulate more wealth by age 65 than someone starting at age 30 with 10,000. So, how do we adjust your retirement plan to fit today's world? This is where we need new defensive strategies, leveraging macroeconomic understanding to safeguard your financial future. Shift from nominal value accumulation to purchasing power accumulation. This is the golden rule. Don't just target X million dollars. Calculate how much goods and services that amount can buy in the future. This is the core of fighting inflation. For example, if you need $50,000 per year to live comfortably today, with an average inflation of 3.5%, projected average for the next few years, you'll need over $70,000 per year after 10 years to maintain the same standard of living. Adjust your savings and investment goals based on this purchasing power figure, not just the nominal amount. Reevaluate your emergency fund in an inflationary era. Your emergency fund is no longer a rigid 3 to 6 months of living expenses. In a persistently inflationary environment, like CPI averaging 3.4% in 2024 and 2.4% in Q1 2025, your cost of living can increase by 3 to 5% annually. So consider increasing this fund to at least 6 to 9 months. If your monthly expenses are $2,000, this fund should range from $6,000 to $12,000. And importantly, don't let this fund sit idle in a low-interest savings account. Seek high-yield savings accounts or short-term certificates of deposit, CDs, with higher rates. For instance, 3 or 6-month CD rates can currently reach 4 to 5% to prevent your money from being eroded by inflation too quickly. Tighten your budget. The battle against phantom spending and hidden inflation. This isn't just about cutting expenses blindly. It's an intelligent fight against inflation. Analyze which costs have surged due to inflation. For example, food costs have increased by over 20% in the past 3 years. Aim to reduce 10 to 15% of your dining out expenses by cooking more at home. Check unused subscription services. The average American wastes $30 to $50 per month on these services. Debt management. Liquidate high-interest enemies before a recession. High-interest debt is a huge burden, especially in a rising interest rate environment and recession risk. Prioritize eliminating high-interest debt. Credit cards and personal loans are top priorities. With credit card APRs potentially reaching 20 to 30%, every $10,000 in credit card debt can cost you $2,000 to $3,000 in interest annually. A massive financial burden if your income declines. Reevaluate other loans. If you have a variable rate mortgage or car loan, consider refinancing to a fixed rate if the opportunity arises. To avoid further interest rate increases during a portfolio restructuring, focus on returns, exceeding CPI. This is the key to protecting your purchasing power. Quality growth stocks and dividend growth stocks. In the long run, the stock market has consistently demonstrated its ability to outperform inflation. For example, the S&P 500 index has yielded an average annual return of approximately 10% historically since 1957, significantly higher than the average CPI inflation rate of about 3.2% over the same period. Seek companies with pricing power, sustainable revenue, and profit growth potential to outpace inflation. Real estate selective. Real estate can be a good inflation hedge, particularly through rising rental income. U.S. residential rents have increased by an average of 5.2% annually over the past 5 years, up to Q1 2025, outpacing CPI inflation in many periods. However, be very cautious with commercial real estate risks, as we've discussed in previous episodes. Commodities and gold. Gold is a traditional safe haven. Gold prices have surged by over 40% in the past year, reaching an all-time high of over $2,400 per ounce in late 2024, and currently trading around $3,330 to $3,500 per ounce in July 2025, proving its value preservation ability. Consider allocating a portion of your portfolio to gold, 5 to 15%. Inflation-protected securities. Tips. These are government bonds whose principal adjusts with inflation, ensuring your original investment's purchasing power is protected. The real yield on a 5-year TIPS is currently around 1.8% in July 2025, providing a positive real return after inflation. Dollar cost averaging, DCA. Strategy: in a declining market, don't panic. Maintain or even increase your DCA strategy to buy more quality assets at lower prices, preparing for the recovery. Strengthen your labor market position. Become indispensable. Retirement planning isn't just about money, it's about your ability to generate income. Develop recession-proof skills. Focus on skills businesses always need, even during tough economic times. Data analysis, project management, soft skills, AI. Industries with high AI skill demand can see wage increases of 10 to 15% even during a recession. Diversify income streams. Don't put all your eggs in one basket. Seek side hustles, freelance, consulting, online businesses to create a financial buffer if your primary income is affected. Beyond the strategies, there are common psychological misconceptions that can derail your retirement plan. We need to identify and overcome them. The "it's too early" myth. Many young people think retirement is 30 to 40 years away. Too early to worry. But as I discussed in part 1, the power of compounding works best with time. Every year of delay is a huge opportunity cost. The earlier you start, the lighter the financial burden and the easier it is to reach your goals. Don't let procrastination steal your future. The government will take care of me myth. While Social Security funds play a crucial role, we cannot solely rely on them. As mentioned, the fund is projected to only be able to pay about 80% of promised benefits by 2033. This is a safety net, not a primary income source for a comfortable retirement. Relying entirely on the government is a risky strategy in the context of rising national debt. The "I'll just work longer" myth. Many plan to extend their working lives to compensate for insufficient savings. However, health, the job market, and job demands can change unexpectedly. You might not have the option to work longer than you wish. Retirement planning needs to be built on proactivity and contingency for the unforeseen. The "investing is too risky" myth. Fear of market volatility leads many to hold cash or invest only in safe but low-yield channels. In a high-inflation environment, this safety is actually the biggest risk, because your money loses value daily. The goal is not to avoid risk entirely, but to manage risk intelligently and diversify your portfolio to outpace inflation. Retirement planning is no longer a simple formula. In a macroeconomically challenging environment, with persistent inflation, rising longevity, national debt, and volatile markets, preparing the wrong way can lead to a retirement filled with anxiety. By understanding common pitfalls, identifying and overcoming misconceptions, and proactively adjusting your strategy with a deep macro lens perspective, you can not only protect your purchasing power, but also build a solid financial foundation for the future. Remember, your financial future is in your hands, and preparing now is the key to a comfortable, prosperous retirement. Thank you for listening to Deep Macro Lens. Follow us so you don't miss our deep analyses of the global economy and the financial strategies that help you navigate all markets. See you in the next episode.